Welcome, everyone. Thank you for joining us for today's webcast. Managing data quality is critical for ACA compliance, sponsored by First Capital Consulting. This webcast has been pre-approved for HRCI and SHRM credit. Please be sure to attend the complete webcast in order to receive your credits. You will receive an email from hr.com within 2 business days, which will include your certification credit information. You may also log into hr.com and go to your View My Credits page, where you'll see the credits you have received. If you have any questions during the webcast, click on the Q&A tab in your webinar controls and type them in there. I'll post a link to the exit survey and the slides in the chat area once the presentation has started. And a new tab will open in your browser with the webcast survey during the broadcast. Please be sure to complete it as soon as the webcast is ended. It is now my pleasure to turn it over to Joanna Brunetti and John Leathers.
Welcome, everyone. We're very excited to be here with you today. Firstly, we're just going to speak very briefly about First Capital Consulting. We are a regulatory technology company, and we specialize in working with workforce data. That's been true for the entirety of our history as a business. And we currently have 4 strategic focus areas within which we focus on delivering value to our clients, those being risk management and regulatory compliance, financial performance optimization, workforce management, and data quality management. We have, for those who care to learn more information about the speakers, we have bio pages that will be available for download after the presentation has completed. And at this point, I'm going to turn it over to Joanna Kim, who's going to be providing an update on the regulatory state of the Affordable Care Act.
Thank you, John. Good morning or good afternoon from wherever you're at. Let's first just talk about what's going on with the ACA enforcement. Next slide. So when we're talking about the ACA, what we're really focusing on is the employer mandate, which is what impacts employers. And what is that mandate? Basically, it applies to organizations with 50 or more full-time or full-time and equivalent employees. This is what's called the applicable large employer, or ALEs. ALEs are required to file these 1094, 1095C schedules with the IRS and furnish the 1095C schedules to the applicable employees. And what these schedules provide is the details of the ALE's offer of coverage to their employees and dependents. And under the employer mandate, if the ALEs do not make the appropriate offers of coverage, they can be assessed this employer shared responsibility payment under 4980H, and we'll talk a little bit more later about the filing and furnishing penalties for not doing so under 6721 and 6722 of the Internal Revenue Code. Next slide. So, you know, ever since Trump was elected to the White House, there was a lot of expectation for the ACA to be repealed. As you might recall, 2017 was the year of attempting to repeal and replace, and with the historical, remarkable thumbs down by John McCain, the repeal of the ACA pretty much shuttered from a legislative standpoint. And now we've got the House of Representatives controlled by Democrats. There is no likelihood that the ACA is going to be repealed legislatively. The one thing that what has happened since President Trump took office, the one thing that happened was through the Tax Cuts and Jobs Act was the zeroing out of the individual mandate, which is the individual mandate to have coverage or be penalized. That was zeroed out starting the beginning of this year. There was one recent court decision in the Northern District of Texas stating that the ACA is unconstitutional because of that individual mandate penalty being zeroed out. Across the political spectrum, there's been the prevailing view is that the reasoning of it is not likely to succeed. Even the fiercest ACA critics believe that it is going to be overturned by a conservative Fifth Circuit, and if not, ultimately by the Supreme Court. The 5 Supreme Court justices that last upheld the Supreme Court, the ACA in the case King versus Burwell, those 5 are still there. And so The prognosticators are very confident that the ACA is here to stay. And in the meantime, while this one Northern District of Texas decision is being appealed, the judge himself acknowledged that the decision is not going to take effect until and unless it actually is confirmed by the higher courts. So, you know, all this noise is basically the employer mandate is here to stay for the foreseeable future. So with that one individual mandate being zeroed out, there is one complication that perhaps employers have not really given much thought, was when they zeroed out the individual penalty. I think a lot of people thought, okay, well, now individuals don't have to be penalized. Well, what's happened is there have been states that are looking to fill that gap with their own individual state mandates. So there's a number of states, Massachusetts, New Jersey, Vermont, and the District of Columbia. They've passed their own individual mandates with their own specific rules. There's a number of states, California, Connecticut, Hawaii, Maryland, Minnesota, Rhode Island, and Washington. Those states are in the process of implementing their own. So what's interesting is, you know, the view was, oh, when the individual mandate is zeroed out, it's gone. But what's happened is now there's just more complication because now it's being done at the state level. Now you got to deal with this patchwork. And if you're an employer with a multi-state operation, that just creates more complexity. Not sure that that was the intent of it, but that is the ultimate impact. Next slide. So while all that noise has been going on, the employer mandate and the penalties relating to that are being enforced and have been proceeding. They started with the 2015 tax year back in November of 2017. So 2 years after, more than 2 years after the 2015 reporting period, they started assessing penalty notices under 4980H. And then about 4 months ago, they started issuing notices for 2016. And it's not clear that they finished the 2015, but they are, you know, full charge on 2016. And we haven't seen the 2017 yet. To the extent that you've seen these penalty notices, you'll see that they can be huge. I mean, we've seen some that have been assessed in the multi-millions of dollars. And the IRS, for the 2015 year alone, they identified nearly 50,000 ALEs as non-compliant. And in terms of penalty letters, they've issued 30,000 or more so far. So we'll see how many more that are coming on 2015. And with regard to the 2016, we are seeing that those penalties are even higher than the 2015 year. And the principal reason for that is that in 2015, there was transitional relief where ALEs had to offer health coverage to only up to, at least 70% of their full-time employees and their dependents. And that increased to 95% in 2016. And that made a huge difference. So if you were an employer and you offered health insurance to, say, 75% of your employees, or indeed 90% of your employees, in 2015, you would have not been penalized, but in 2016, you would have. So it's a huge deal. Next slide. It's a huge deal because of the dollar amount. So the A penalty, that's what a lot of people call this hammer penalty. The A penalty is the penalty for failing to offer health coverage, and it's a very loosey-goosey standard. It's basically an employer-sponsored coverage, very broad. But if you don't, you need to offer that as an employer, as an ALE, to at least 95% of your full-time employees and their dependents for every month. Now, if you fail to do that, and at least one full-time employee obtains a PTC for that month, you get tagged for that month. So if in 2015, you fail to do that every single month, you're looking at roughly about $2,000 per month times the number of full-time employees minus 80 in 2015, and that number goes back to 30 in 2018. So the B penalty, which is a different penalty. The A penalty is for not offering coverage. The B penalty is for not offering adequate coverage. And what I mean by adequate is that it needs to provide minimum value. It's a certain types of, I'll call it the quality of coverage. Basically 60% actuarial value of cost to services. And also that it needs to be affordable for each full-time employee. And the B penalty is triggered on a per PTC employee basis. The A penalty if you've got 1,000 employees in a given month and only one person got a PTC, if you didn't hit that threshold of 95% in 2016 on, you would get tagged for all 1,000 employees minus the 30 freebies that you get. So it's a huge penalty, even though only one full-time employee got a PTC. The B penalty is on a per employee who obtained a PTC. So if you only had one employee that got a PTC, you only get tagged at 3,000 annualized per year for that one employee. So the A and B penalties are basically assessed on a monthly basis, and you can't be assessed more than an A penalty for a given month. Okay, next slide. So we've been talking all this time about the A penalty and B penalty. That is in connection with the 4980H penalties. Now, there's a separate penalty under 6721 and 6722. Now, these penalties are basically penalties for not filing and furnishing accurate and complete and timely schedules. There's the 1094C schedules and the 1095C schedules. The 1095C schedules are the ones that are supposed to go to every applicable employee. Those are supposed to be furnished with the employee, delivered to the employee, and also filed with the IRS. The 6721 penalty is the penalty associated with not timely filing correct and complete schedules. The 6722 penalty is the penalty for not furnishing to the applicable employees complete and timely and accurate forms. So basically, the penalty is a twofer, because there's a penalty associated with 6721, there's a penalty associated with 6722, and for example, if you didn't create a 1095C schedule for a given employee, you've not furnished it, you've not filed it, you're going to get tagged double the amount of the penalty. So what the IRS has been doing with regard to these 6721 and 6722 penalties, and they just started coming out. We've seen these letters, IRS letter 5005A with an attached form 886A. There's no good abbreviation for that. But anyway, this penalty letter basically assesses the penalties, the 6721 and 6722 penalties, based on the failure to file anything. What typically happened is that the employer got a letter, like a precursor letter, which was a letter 5699, basically saying, are you an ALE? And there are some employers that just ignored it. And if you ignored it and didn't respond and provide the information requested in that 5699 letter, the IRS would follow up with this 5005A letter. And that 5005A letter assesses penalties based on the number of W-2s. And most employers, you don't have, not every employee that you have worked all 12 months of the year, and you will typically have more W-2 employees for a given year than, say, the average number of active employees for the year. So what you see is you see an overinflation of the penalty. So the IRS has the data to, through the W-2 reporting, they know what an employer's W-2 is. They may or may not know your full-time count, and if you didn't file the 1094, 1095 schedules, the IRS wouldn't know that per se. So what they do is they use the W-2 number as a proxy, and it tends to overinflate the penalties. And for these kind of penalties, we've also seen penalties in the millions of dollars. And as I said, if you didn't prepare them, you're going to get tagged both for the failure to file and for the failure to furnish. So you're talking about double the penalty. Next slide. Okay, so this is what a typical 5005/886A letter. So it tells you what schedules they were expecting you to provide, and they're assuming you're an ALE because you didn't respond to the letter that asked whether you were an ALE. And mind you, that letter where they asked you if you were an ALE, they want you to prove it. So let's say you didn't respond. Well, now here's the letter saying we're just assuming you're an ALE because you didn't respond. And this is the penalties. And if you look over at the right-hand corner under government position, you see IRC 6721, IRC 6722. They basically double the penalty, the failure to file and the failure to furnish. So if you didn't file a 1095C, for example, you get double the penalties. Now, as you see below that, it says the IRS determined the employer filed 2,157 W-2s. It's just this one particular employer. But, you know, in reality, this particular employer had a lot less full-timers, and instead of, you know, being tagged on a penalty, so they basically took the 6721 penalties, which I'm going to go over on the next slide, but that penalty is multiplied by the number of forms, when it really should be multiplied by the number of full-time employees. So you got to do the work to figure out what the full-time employees and do the schedules in order to use that number. So that right there, that one is an example of how they can overinflate it, and it's up to the employer to prove otherwise. Next slide. So we talked about these 67, 21, 22 penalties, but we didn't talk about the dollar amount. As you can see, these penalties are humongous. Currently, for the returns that are due this year, that were due last year, what we're looking at is, if you didn't file at all, you're looking at a $260 per return. Now, if you had, let's say you had 100 full-time employees and they were all supposed to get one, that's, you add 2 more zeros, that's $26,000 per return / employee for the employees, and then you have to double it, because one for failing to file and one for failing to furnish. So what you're looking at is $520 per return. You got 1,000 returns. That's, oh gosh, my math is, that's $520,000. That's $500,000. That's a lot of penalty for failing to file and furnish. Okay, next slide. Next slide. Oh, okay. So here are the deadlines there that have been going on for for the ACA reporting, and the most pertinent ones are the ones that are coming up. And you'll see that you know, in a couple of weeks, we've got the actual manual filing. Those are the ones who are paper filing. And if you're an employer with no more than 250 returns, you are allowed to paper file. But the rub is the deadline's earlier. If you have, you know, more than 250 returns, whether it's 1094 or 1095C schedules, you must file electronically. But the upside is you get a little bit more time. So these deadlines are coming up, and then ultimately the ones for the individuals that are supposed to receive these 1095Cs, the applicable employees, i.e., you know, the full-time employees, they got to get their return, their schedules by March 4th. So these are coming up. And what we're seeing is the IRS is seriously taking enforcement. This generates revenues for the IRS. You know, it helps fund the ACA. So there's a lot of motivation to enforce it. And the IRS, by all measures, is doing just that. Next slide. Now, so we talked about the 2017, we haven't talked about it, the 2017 ACA filing. Now, mind you, employers are in the process of filing, preparing 2018 returns. Now, it is now 2019, and the IRS is just reviewing the 2017 ACA filings. And like for employers, you know, the IRS did this ACA, these schedules. It's new to them, is just like it is for employers. So they're getting better at it. You know, they've been using this automated Affordable Care Act compliance validation system. And what this does is it really just kind of uses an algorithm to, one, identify non-compliant organizations based on the highest value of work. Initially, for the 2015 reporting year, it was more of a random selection process, but the IRS has gotten better at it. They've become more efficient in identifying who hasn't complied, and that really speaks to that 5699 process letter, which ultimately results in the 5005A letter. And what we're seeing is they're getting faster at it, they're getting more efficient, and as the IRS becomes more, develops it more and understands it more, they tend to have less leniency towards the employers, because now we're looking at 2015, 2016, 2017. We've got now 4 years of reporting. Employers in general had 4 years, that are ALEs, they've had 4 years to get this process right. And that good faith transition relief that had existed for earlier years, part of that relief is to demonstrate to the IRS that if you made mistakes if your schedules were not filed correctly, and this, and let me just step back for a minute, that good faith transition relief is helpful to avoid the 6721 and 6722 penalties. Those are the filing and furnishing correct, timely, and complete forms. If you didn't do that, and of course you have to file on time in order to take advantage of this transition relief. But assuming you've done that, but the forms are wrong, for example, you could take advantage of the good faith transition relief if you can show that you were acting in good faith. The problem with that is part of showing that you were acting in good faith is that if you made a mistake, you ended up getting a vendor or getting better at the process. So for example, if you used a third party to do your schedules and they had messed it up, that you didn't stick with that vendor, or that you hired someone who understands the process and were able to correct the forms. So basically, you can't rely on good faith transition relief by doing it wrong year after year without showing any improvement in your process. So as we continue with these ACA filings, it's very important to make sure that you're doing it right, and if you've done it wrong, that you've improved those errors, that you've actually learned from those errors. Next slide. Okay, so I'm going to turn it over to John Leathers, who's now going to talk about managing data quality for ACA compliance.
Thank you, Joanna. Okay, next slide, Gary. Let's dive in here. So just to add to that regulatory update, before I dive into my piece here, I will also note that over the last 14 months, we have seen a dramatic increase in both the sophistication and the stringency of the IRS, the Department of Health and Human Services, and the various state exchanges. They've been issuing more exchange notices to employers. They've been more detailed with their information requests, and they've been a lot less forgiving in terms of accepting documents that don't exactly meet their standards for information requests. And as well, so First Capital Consulting is also involved with helping organizations that respond to 226J notices that propose those 4980H A and B penalties that Joanna was speaking to. We've also seen the sophistication of the auditors involved increase dramatically over the last 14 months. So on that note, it's important, when we think of Affordable Care Act compliance management, we really think of these three important buckets. So number one, it's important to have appropriate regulatory knowledge throughout the organization. So in terms of the awareness, being aware of the various regulations and notices that are issued. New notices are issued from time to time. And so it's very important to have either individuals internally within the organization that are monitoring those, or be working with a vendor that is doing that for you, to be aware of what's going on, and then also ensuring that that knowledge is being disseminated throughout the organization to the various stakeholders involved with Affordable Care Act compliance. We see deficiencies when working with clients around the interpretation and the implementation of that regulatory knowledge. So as an example, we rarely see employers correctly interpret the look-back measurement method and apply it. And even for those that do, let's say their interpretation of the regulatory knowledge is adequate, we see gaps in the implementation on an ongoing basis. So number one is regulatory knowledge. Number two is this idea of documentation and record keeping, having strong internal controls and process in place to ensure that as you are going through the year, you're actually not just doing what you're supposed to be doing, but documenting that, such that in the event of a regulatory inquiry or audit by the IRS, you are able to substantiate that you've been doing what you say you've been doing. So we see many employers that receive notices from the IRS, and they it's clear from a certain perspective that they've been in compliance, but because they failed to keep proper documentation around that, it's very difficult to just tell the IRS, oh, I've been doing what I say I'm doing, and just trust me at my word. So it's very important to have strong documentation and record keeping to be ready for an audit. And then the third piece is this idea of data quality management. And this is one that we really don't see much attention given to. Data quality management around the Affordable Care Act is so critical because of the simple fact that any analytic outputs are only as good as the raw data that's feeding those calculations. And so if we go to the next slide here, Gary, there's a couple key words on this slide that I want to focus on. The first word is monthly. One mistake that we see many employers make is they fail to adequately treat the Affordable Care Act compliance process as a monthly process. And workforce data is so dynamic, it's constantly in flux. People start, people leave, data is updated in the various technology platforms within the organization. And so it's important to be monitoring the data within your organization on a regular basis, at least monthly. And so if we look at this visual here, we see these four data domains of time and attendance data, health benefits data, HR data, payroll data. On a monthly basis, one thing that many organizations struggle with is for those that are using external vendors, it's up to them to really unify and transform that data, to manipulate it into a format that, that can then be ingested by their vendor's data platform. And so there's difficulties around that transformation process. It's administratively burdensome. And they invariably actually end up creating data problems, exacerbating any already existing data issues as they try to really wrestle and jam that data together. Once that data has been unified and transformed, it needs to be cleansed. And we will go into a little bit more detail on what exactly that means here shortly. But really, it's this idea of validating the data to ensure that you're identifying properly any inconsistencies that exist between the various platforms, between data fields, to monitor that, and then to bring that cleansed data back into the system, into the data systems within the organization, such that for future months, it's now accurate. Once you've cleansed the data, you're ready to perform the ACA analytic calculations, for example, determining your full-time folks that are pending full-time status. But that cleansing piece is something that is very often skipped by employers. Really not much attention is given to that. So the key though is that it is a monthly process. So next slide, Gary. Just to reiterate, really having worked with the Affordable Care Act for since its inception, prior to its inception, we really have become aware that many of the complexities and the challenges are really data problems for organizations as they seek to comply with the employer mandate. And, it is true that the larger and more complex the workforce, the greater those data challenges are. Those reasons being you just have more data, so there's more opportunities for it to get corrupted. As well as you end up having, generally speaking, more technology platforms and systems. But it's important to realize that smaller employers also face many data challenges, and their resources are not at the same level as larger employers. So, although perhaps the issues they face are not as large in terms of the volume, they're less able to handle them because of their limited resources. Another thing to note is that if you are working with an ACA vendor, many of the systems really allow end outputs, meaning key calculations in the ACA context, to be performed with no attention given to the quality of the raw inputs. So no validation given to checking whether those data values, the raw inputs that are going into those calculations, make sense. And that's going to end up creating flawed outputs, flawed calculations that end up being repopulated into the 1094C and 1095C schedules, which is going to create regulatory issues. It's going to create risk issues when filing with the IRS. And before we dive into a little bit more detail, just as a general little fact here, we tend to see, as we're delivering our compliance services, a 5 to 10% discrepancy level between the data that's in the payroll systems versus the data that's either housed in a Ben admin system or in a workbook that the employer is tracking, for example, enrollment and eligibility dates. So next slide. So why does data quality matter, really? Why should you care? Why should anyone care about data quality? To be clear, when we've represented employers that have received penalty notices from the IRS, when we look at the root causes of what led to them being assessed penalties, and as Joanna mentioned earlier in the presentation, they can be as high as in multi-millions of dollars. When we trace that, it always ends up being data issues that caused those problems. And so there are other issues that end up arising outside of these two, but data quality issues are going to create one of two scenarios that are going to adversely impact the organization. And so the first one is a full-time employee slipping through the cracks, where an employer fails to properly identify an employee as an ACA full-time employee because their calculations weren't performed correctly because the raw data inputs weren't cleansed appropriately. And then the second situation is when an employee is incorrectly identified as ACA full-time, and that can itself also have negative implications and ramifications for the organization. So let's look at these a little bit closer here. Next slide. For this situation of a full-time employee slipping through the cracks, what's going to happen is you're creating a situation where you may be assessed for 4980HA penalties. So again, that's that failure to meet the 95% offer of coverage threshold. And to remind everyone, that penalty is assessed if just one full-time employee receives a premium tax credit. And it's levied using the entire full-time count across the organization, as Joanna clarified earlier. Even if you met the 95% offer coverage threshold and a full-time employee slips through the cracks due to data issues, you're exposing yourself to 4980HB penalties if that same employee goes and obtains a premium tax credit, and as well as 6721 and 22 penalties for failure to accurately file the 1094C and 1095C schedules. So as Joanna mentioned, in recent weeks, we've started to see those 67, 21, 22 penalties issued in the ACA context. And we anticipate that just as we've seen with respect to the 226J letter process and with the exchange notice process, the IRS sophistication around drilling down around inaccuracies will only increase over the next 6 to 12 months because that's the general trend that we've seen with again, the exchange notices and letter 226J. So next slide. The other situation is this situation that can arise where employees are incorrectly identified as ACA full-time. And so we like to refer to this as the hidden C penalty. Everyone should be very familiar with the A and B penalties. But the C penalty is this notion that the employer, by incorrectly identifying someone as ACA full-time and then extending an offer to that individual that they did not need to, is contributing for health premiums on behalf of that employee that they did not need to because the employee was not actually ACA full-time. And so what can happen as a result of that is that the employee is actually adversely impacted. This generally is more of an issue for lower income earners, but it's a very real issue, and it's one that we see organizations struggle with and deal with, where what they don't realize is that by offering health coverage, particularly to lower income earners, they're precluding that individual's eligibility for a premium tax credit on the state or the federal exchange that applies to that individual. And that can create a situation where the plan that the employer offered is not as good as the plan that the employee would have been able to qualify for on the exchange, particularly once the premium tax credit is calculated in. And so there's real ramifications that can arise both to the employer and to the workforce population. And again, this type of a situation could result in 6721, 6722 penalties if that employee, the codings are populated incorrectly on the 1094C and 1095C schedules. So next slide. So again, to refresh, what data silos, what data domains are we talking about here? Well, it's really human resources data, it's time and attendance data, it's payroll data, and it's health benefits data. And depending on the organization, these data domains may be discrete, unique technology platforms, or they may be consolidated and managed perhaps together. Sometimes we do see organizations that have 4 different platforms for these domains, but more typically we'll see human resources, time and attendance, and payroll together. Sometimes we see a system that does it all. Sometimes we see a system that just payroll and time and attendance with separate HR and benefits. A lot of times we see that organizations don't have a benefits administration technology platform at all, and they're tracking that in spreadsheets and workbooks. And so there's many different combinations that can arise depending on the specific employer, where this data is being stored in different ways and to different levels of sophistication. So next slide. And so just to drill down on the specific data points for those here, you know, when we think of HR data, we're generally speaking about census identifying information for employees. So name, address, social security number, hire, rehire, and termination dates, things like the date of birth, union status, and the state within which the individual resides. When we look at time and attendance, we're looking at things like leaves of absence, the hours of service, special unpaid leaves that are important to track if an employer is using the look-back measurement method. And so you'll note that hours of service is listed twice in time and attendance and in payroll. We do, for employers that are using different platforms for TNA versus payroll, we frequently see discrepancies and inconsistencies between the hours of service listed in the payroll versus the time and attendance platform. And those create a situation where that needs to be reconciled. And it's important to do that. Under payroll, we're looking at wages, again, hours of service. At the end of the year, the W-2 Box 1 amount that's used to perform the W-2 Box 1 affordability safe harbor. The payroll period, start and end dates, the rates of pay with the effective date, and titles and employment statuses. And under health benefits, the key data points are eligibility periods, right? Over what period was an individual actually eligible for health coverage? Because that needs to be reported on the 1095C schedule on line 14. The enrollment periods, what is the individual benefits class, and also this notion of audit readiness monitoring. So you can be tracking all these data points, but it's also important to understand over what periods of time do I actually have hard supporting documentation to be able to substantiate in the event that the IRS audits that an individual is actually eligible for health benefits. So that means things like signed waivers or a time-stamped election in a Ben admin system or platform. Things like that are going to allow the employer to be able to, in the event of an audit, really prove to the IRS that what they're saying is true. Next slide, please. So in talking through data quality, really when you think through the life cycle of a data point, it's very simple. Data is created, and it's typically created by personnel. That data is then stored in a database, a spreadsheet, a technology platform. And at some point, it's then extracted for use in analysis or a report. And so, next slide. If we think through the root causes in the context of each one of these categories that create data quality issues down the line, they're very straightforward, they're very simple in concept. You know, at the data creation point, it's very common to see data entry errors by personnel. And another thing that we see that's very common is that although many systems actually allow an employer or an employee, excuse me, to track multiple instances of a particular field over time. What I mean by that is if the rate of pay changed for an employee in January and then it changed again in July, many systems actually allow that distinction to be tracked, but what ends up happening is that there is this erroneous overriding of a status field such that the status at different points in time is not being tracked. Rather, it's just being overwritten. And we'll talk a little bit more about how that creates issues. In terms of data storage issues, just the simple fact that there's these different data silos that are housing these different data, that really creates issues that create administrative a burden for employers as they seek to really wrestle that data together as needed, either on a monthly basis if they're being good about their compliance efforts, or at the very least at the end of the year when it's time to report to the IRS. Invariably, the difficulty in wrestling that data together creates data quality issues that perhaps didn't even exist initially, because the individuals that are working to transform that data are just not that familiar with pulling these different data domains together. And finally, we have data extraction issues. So we talked about the manner in which certain systems should allow you to track various status changes throughout time. But even if that's the case, and by the way, we also see many platforms that do not do that, which creates its own issues. But even if that's the case, typically those status changes are only accessible or viewable when drilling down to the actual employee file level. Meaning if I go into the system and I navigate specifically to John Doe's employee profile, I would be able to see that John Doe, he was working 24 hours a week and his rate of pay was $18 an hour in the month of January, and then that subsequently changed 14 months later. But when pulling reports at the aggregate level across the workforce, those status changes are invariably not actually reflected. And what you end up pulling is just the status that is true as of the date that the report is pulled. And so in talking through this issue with various employers that we've supported that have been responsible for managing this on their own, we see that they end up accidentally populating their ACA vendors' technology systems incorrectly because they're not pulling the historical statuses for their employees. And what that ends up doing is creating inaccurate analytic outputs in the ACA context that, again, can lead back to one of those two core issues we identified of either incorrectly identifying an employee as full-time or allowing a full-time employee to slip through the cracks. They weren't identified as full-time. So next slide, please. We also, there's this issue of unstructured data where what we mean by this is, and there's a nerdy data joke that all unstructured data is just structured data it just hasn't been structured yet. Essentially hasn't been data entered or logged. But employers collect all kinds of unstructured documents and data, meaning it's not in a neat table, row and column format, but it represents important data that should be analyzed and should be ingested in that ACA analysis on a monthly basis. So things like the health insurance waivers that, again, show an employee's signature and link that employee to eligibility over a particular time frame. So if an employee signed a waiver and that waiver indicates that employee is eligible for health coverage for the period of January through December, now you know that for the months of January through December, you're able to actually defend the organization in the event of an audit if that audit has to do with that particular employee. And so many organizations don't, because of limited resources, don't really have a sense for their audit readiness in this context because they don't have the resources to really structure these types of unstructured documents. So just wanted to make a quick note of that. Next slide, please. So when we think of data quality issues, we really think of it through this lens of these 5 different dimensions. completeness, validity, internal consistency, external consistency, and anomaly detection. And we'll drill down on what each one of these mean with actual examples, just to make this a little bit more concrete. So next slide, please. So when we think of completeness, this is perhaps the simplest of the dimensions. Are there missing values, right? If there's missing values, that's going to create critical issues. But oftentimes, for whatever reason, these things aren't checked for. So are we missing social security numbers for employees? Are we missing hire and termination dates? Are we missing rates of pay that are critical for performing affordability calculations? So that's completeness, very simple. The second dimension is validity. So when we say validity, we mean, does the data conform with its schematic requirements? So to make that a little simpler, a social security number should have 8 digits. A zip code should have 5 to 9 digits, depending on how the system stores it. A state code should have 2 digits. Very simply, does that data point just match the schematic requirements of that field? So checking for things around this. And the concept is simple, but if you have thousands of employees or thousands of records, it's very helpful to have a system that can perform this in a very quick and automated fashion, these types of checks. Next slide, please. The third is this idea of consistency of information across data silos for the same data element. So we talked about how oftentimes employers do have different technology systems or platforms. And when we talk about consistency of information across silos, we're talking about, does the data point match in, for example, payroll versus ben admin? Does the legal name, for example, that links back to social security number match in payroll versus the benefits administration? The legal name is going to be critical because that legal name is what gets populated on the 1095-C schedule. So these discrepancies, and again, we generally see a 5 to 10% discrepancy level between payroll and benefits administration. They need to be resolved to be able to adequately arrive at a single source of truth. So next slide. The fourth dimension is this notion of consistency of information between data fields. And so do data fields make sense in the context of other data fields or information? And so these questions are generally domain specific. The algorithmic flagging process should be created by domain knowledge experts that really understand the data in the context of, in our case, as we're speaking here today, the Affordable Care Act compliance process. So, but to make this more concrete, as an example, many times we see that the hire and termination dates don't make sense when compared to the actual wage and hour patterns. And if there were no check being ran, then those hire and termination dates would just be populated into a system, and they would be used to calculate employment periods, which really form the entire foundation of the narrative that's communicated to the IRS on the 1095-C schedule for an employee. And so the hire and termination dates, they end up being inaccurate because people leave and go, and as personnel is tasked with making those updates, sometimes the system doesn't allow them to track multiple hire and termination dates, or other times it's just overwritten. Sometimes we see organizations where they tell themselves, oh, well, so perhaps if they have a high proportion of variable hour employees, their employees come and go, and they don't really track the rehire and re-termination dates, because they just have this sense that, well, the employee will leave for a few months and they'll come back. And so there's these discrepancies that exist, and it's important to be identifying those discrepancies between the hire and term dates and the wage and hour patterns. Other examples are discrepancies between the enrollment periods and the eligibility periods. So again, these are all algorithmically flagged. It makes it much easier to catch discrepancies if you're able to do it in an automated fashion, as opposed to having to go employee by employee. So next slide. The last dimension is this notion of anomaly detection. So there's really two categories of anomaly detection. One is identifying unlikely values, so values that are just very infrequent from a statistical perspective. that may make sense when viewed through the lens of the other 4 dimensions, but they're just very rare occurrences. So for example, if one person is being paid an extra paycheck every other month, but no one else is, or an employee is listed as working 450 hours for a month, but everyone else is working 190 hours on average. So they're, well outside of 2 standard deviations from that statistical average. Another category is values that are just impossible, right? So, for example, if an employee is listed as working 800 hours of service for a month, that can't be true because in a month with 30 days is only 720 hours. So just flagging these types of occurrences so that they can be investigated further. The data can be cleansed, ingested, and re-ingested into the platforms, and that way the ACA analysis that takes place is accurate. And so next slide, please. Here we just have some specific examples just listed out in a table format. We have the issue of inconsistent hire, termination, and rehire dates that we spoke of, and that one's kind of highlighted separately from the rest because it's so endemic across the hundreds of employers that we've supported. This is a very big issue, and it's very difficult to reconcile unless you've established an internal control to be able to identify that. And it results in inaccurate application of the IRS measurement methodologies. It results in inaccurate determination of ACA full-time employees, and it results in employees not being made timely benefits of health coverage offers. And on the right column lists the potential penalty implications of each one of these issues. I'm not going to go through every issue, but they are displayed here for you to be able to review when you download the slides. The second item is a missing pay basis, which is going to result in the inability to apply a rate of pay safe harbor. Other examples are, things like number 6, employees with wages but no hours of service. So this is a very normal occurrence for individuals like, salaried employees, but it needs to be properly accounted for in whatever system you're using so that the IRS calculations are being performed accurately. Next slide, Gary. Things like negative hours of service, which are very common as people make adjustments to the payroll. If those are not accounted for and treated prior to performing the ACA calculations, that's going to create errors because the hours of service, again, are so critical, whether you're using the monthly measurement or the look-back measurement methodology to determine the full-time status. Lastly, we have issues like hours of service post-termination, where depending on the system that you're using, this could lead to, if not flagged appropriately, individuals being treated as active when they're not. And so what that's going to end up doing is it could create an issue where perhaps an individual is treated as being actively employed but not eligible for health benefits, so you're creating penalty exposure for yourself, or you're incorrectly reporting to the IRS as to their employment status for a particular month, which can create potential accuracy issues under IRC 6721 and 6722. So again, I'm not going to go through all these in detail. At this point, we are just going to go to the last slide here. So key takeaways. The ACA data quality has very real financial implications, so it's important to take it seriously and to, on a regular basis, really be monitoring that data to ensure that that the analytic outputs in the ACA context are being performed correctly. So have processes and controls in place to monitor that data. It is an ongoing process, and the reason for that is because workforce data is so dynamic, it's constantly in flux, the workforce is constantly changing, employees start and leave, records are constantly updated. And so it is again, it's an ongoing process. And so last slide here. Just to end on the visual again, this really should be the ideal process that's taking place on a monthly basis. That unification and transformation process, subsequent cleansing, and once you've cleansed and really ensured that the data is ready to be analyzed, that's when you perform the calculations and the analytic outputs, meaning things like the determination of full-time employees, offers of health coverage, and ideally, any discrepancies that have been identified are then resolved and updated in the actual technology systems and technology platforms. And so at this point, we'd like to do some Q&A. I don't see any questions.
John, we have a couple of questions in.
Okay, great.
The one thing that people are asking is, if monthly is the best practice, when we find people who have been penalized, do we find that they also have not been tracking their data monthly?
Yes. I mean, I can't overstress the level to which this is really just, it's an afterthought, if it's even a thought at all. Organizations, unless they're really coached and instructed and guided as to really set up these types of processes to monitor that data quality, they're either not thinking about it at all, or they're thinking about it and then shoving it to the side. Just because it does take a fair amount of time to establish that type of a process, but the reward and the value that you get are well worth the front end effort. Because once you get it established, it to a certain extent is able to really operate on a much easier basis, once it's going. But you just have to put in the work up front to get it set up.
So we have another question. If you offer health insurance to both full and part-time employees, does that mean you're at risk for the hidden C penalty?
Not technically.
Go ahead.
Basically, if you've submitted a 1095-C and it's wrong, you can get penalized under 6721-22. But you're not required to submit a 1095-C for someone who isn't full-time under the ACA. So you're kind of asking for trouble if you're, essentially voluntarily submitting a 1095-C and now it's, filled with errors. Does that answer? Or?
John, did you want to add anything?
No, yeah, that makes sense. That was my understanding of the question and answer.
So another question, how do you manage a broad range of scheduling for part-time employees? I work in public safety and we have scheduling from 12 hours up to 48 hours at a time. Scheduling comes down to part-time staff as they have the autonomy to sign up for vacant shifts. That being said, monthly schedules are always different.
So I'm taking the complexity here, or the potential risk issues just arising from the fact that these individuals are able to self-schedule. And so in providing that autonomy, the employer is giving up some amount of control, particularly if these individuals are not expected to reach full-time hours, and accordingly haven't been offered health coverage. I don't think there's a cut and dry answer that can really necessarily solve that issue. It would be something that we would probably want to sit with the organization, come up with a solution that works sense for everyone. Because
I wanted to add, John, that certainly makes a lot of sense from an ACA reporting standpoint. If they're doing the look back, they don't have to worry about the sort of immediate scheduling. So while from a managerial operational standpoint, being aware of the scheduling is obviously critical, but purely from an ACA reporting, if they're doing the look back, it doesn't matter what they're doing right now, as long as they got all the data for the prior measurement period, right?
Absolutely, yep. So long as they're using the look back measurement method, and the employees are appropriately tagged as part-time, variable, or seasonal.
Right.
So I believe we have time for one more question, and anybody whose question has not been answered, we are going to send written answers to everybody who's asked a question, so you can have it in writing. Final question, John, you talked about validating data. What kind of process could you recommend to help companies and organizations more easily find inconsistencies in their data before they submit their information to the IRS?
Sure. So, I would definitely recommend that the process take place more frequently than once annually. Again, I can't stress enough that really people are not paying attention to this at all. So if they're even doing it once annually, that's a big deal. I would definitely recommend to make it more frequent than that, quarterly or ideally monthly. But then in terms of how to actually set that up, it's dependent on the systems and the platforms that they're using. And you know, it's really just taking the time to really go through the data, through the different data fields to identify where what are the highest probability areas that are likely to create risk. And so that's really going to be just specific to that particular employer's systems and platforms that are in use.
Hester, do we have time for one more question?
Sure, go for it.
What do you do when MEC is offered and the employee gets coverage through the exchange and receives the PTC, and you receive the ESRP with the penalty?
Basically, the employer really is only expected to control whether or not the employer is making the offer of MEC. So if you've offered it, and it's affordable and meets minimum value, the employer is not going to get tagged for penalty regardless of whether the employee gets a PTC or not. Technically, if an employer actually offered MEC that was minimum value and affordable, the employee would not be eligible for a PTC. Value and affordable to that full-time employee, and if the employer has done that, regardless of what the employee gets a PTC or not, the employer is not going to be penalized. And if you get, like, let's say you get a 226J letter assessing that ESRP penalty for that employee, if you as the employer, you want to show that that employee got that offer of MEC, minimum value and affordable, and then the IRS will you know, eliminate that penalty because you as the employer weren't supposed to get that penalty. But you're going to obviously have to prove that.
Hester, over to you.
Okay, well, thank you for this great webcast today. I'd like to thank you as well as all of our attendees for joining us today. If you'd like to view this webcast again, the archive recording and slides will be available for up to 7 days for our free members and without restrictions for those with our certification membership. The webcast credit will show in your HR.com account within 2 business days, and we will also send you an email with your credit information. Your feedback is important to us. Please take a moment to fill out the exit survey that opened in a new browser page on your computer. This concludes our webcast. Enjoy the rest of your day.